Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Broadcom.
If you find our talks useful, please consider subscribe, like, and comment underneath. And just a quick note before we jump in, be sure to check out the special 14-day trial link below in the description for StockOracle.
Right, which is a really fascinating tool for this kind of research.
Yeah, exactly. It is an affiliate link, so we may earn a commission at no extra cost to you. And just to be clear, StockOracle is an AI-aided stock research platform. It is not financial advice. It's not a trading signal service or, real-time market data.
And keep in mind, their AI insights and valuation estimates can be incomplete or wrong, so always verify important facts yourself.
For sure. So getting into Broadcom today. Imagine printing over $18 billion in pure cash in just 6 months. You're growing your top line by 32% and operating with a near 70% profit margin.
It's just staggering. In any rational market environment, a company posting those kinds of numbers is basically the undisputed king of Wall Street.
Right. You'd think they are virtually untouchable. But last week, Broadcom posted those exact metrics, and the market responded by violently wiping nearly $25 off its share price in a single day.
Yeah, a near 6% intraday plunge. It is a phenomenal disconnect. We are essentially looking at a masterclass in market psychology versus corporate fundamentals here.
Definitely. Which is why, for today's talk, we are really unpacking this Broadcom paradox as it stands right now in mid-August 2026.
Because you have a semiconductor and networking giant that is structurally essential to the entire artificial intelligence boom. They are staring down the barrel of a projected $4 trillion market cap by 2028.
And yet, institutional investors just dumped the stock. So for you listening, whether you're managing a portfolio or maybe you're building infrastructure in the tech sector or just trying to decode the massive financial machinery operating behind the AI revolution, this is a wealth-building context you really need to monitor.
Oh, absolutely. We are looking at this intense tug-of-war between spectacular revenue growth and some incredibly complex, kind of shadowy financial risks that are just starting to surface.
Yeah, so to figure out why the stock cracked, I think we first have to measure the sheer size of the pedestal it's currently sitting on. Let's look at the fundamentals.
You really do have to respect the scale of their fundamental engine.
Yeah.
Broadcom's trailing 12-month revenue leading into this current quarter sits at a massive $41.498 billion.
Which is huge.
It is. And sustaining a 32.29% year-over-year growth rate at a $40 billion run rate.
Yeah.
That defies the typical laws of financial gravity for a company of this size.
Because it's not just about selling a high volume of generic chips, right? It's about their structural monopoly on the networking bottlenecks in these AI data centers.
Exactly. And the margins really tell that story. They are operating with a gross margin of over 68%.
Wow. Over 68.
Yeah, and a net margin pushing 39%. Plus, they're sitting on $19.6 billion in cash reserves right now.
When I look at those numbers, the immediate analogy that comes to mind is that, Broadcom isn't competing in the AI gold rush by digging for gold. They basically built the only high-speed toll booth on the AI superhighway.
That is a highly accurate way to look at their custom silicon and networking switches, yeah.
Because every hyperscaler, whether it's Google, Meta, or Microsoft, who is building out these massive AI server clusters, they have to pay the toll to Broadcom just to get their GPUs to communicate with each other.
Right, because when you put 100,000 GPUs in a server farm, they are essentially useless in isolation.
Right. They can't do anything on their own.
Exactly. The massive neural networks driving modern AI require those chips to talk to each other with near zero latency. And Broadcom designs the networking infrastructure, the switches, the Ethernet components that make that data transfer possible.
And since there's virtually no viable alternative that can match their throughput at that kind of scale, Broadcom commands software-like margins on physical hardware.
Which is wild. Keeping 39 cents of pure profit on every single dollar of revenue, after all taxes, R&D, and operating expenses, that is how you generate $18.2 billion in free cash flow in half a year.
But this is where I have to push back a little bit on the valuation, because to own a piece of this toll booth right now, the market is demanding an astronomical premium.
Oh, for sure. the multiple is steep.
Yeah, the stock is trading at a PE of 68.35 and a price-to-sales ratio of 26.55. I mean, when a hardware company is trading at 68 times its earnings, isn't absolute perfection already baked into that share price?
You are identifying the exact vulnerability that caused that recent sell-off.
Because if you're buying Broadcom today, you aren't just betting that AI is the future. You are basically betting that the massive capital expenditures from the hyperscalers will never, ever experience a single quarter of deceleration.
Right. A PE of 68 is priced for a flawless, uninterrupted trajectory of hypergrowth.
Mm.
Investors are paying up for a reality that hasn't even happened yet.
And in the hardware sector, which is historically pretty cyclical, sustaining a multiple that high means you have to constantly exceed increasingly aggressive analyst estimates, right?
There is zero margin for error. The moment the market sniffs out a potential headwind, the multiple doesn't just compress slightly, it violently resets. The underlying business can still be incredibly strong, but that premium just evaporates.
Well, let's talk about the specific headwind that triggered this reset. The risks and catalysts that wiped 6% off the stock in a single day. We're calling this the $370 billion question.
Yes, and this revolves around a financing vehicle known as the XPV platform.
Right, which requires looking past the income statement and diving into off-balance sheet liabilities.
Exactly. So XPV is an AI equipment leasing platform co-established by Broadcom, Apollo, and Blackstone.
Okay, the private equity heavyweights.
Right. And Bank of America recently published a projection estimating that this specific vehicle could accumulate up to $370 billion in senior debt by mid-2029.
Wait, $370 billion. Let's unpack the mechanism here. Why does a company with nearly $20 billion in cash need to team up with private equity to create an equipment leasing platform in the first place?
It really comes down to the staggering upfront cost of AI infrastructure. The hyperscalers and secondary cloud providers, they're trying to build out data centers that cost billions of dollars to outfit.
Right, and they don't want to tie up all their capital.
Exactly.
Mm.
Many of these companies, especially the smaller Tier 2 cloud providers, they just cannot or will not pay for all that hardware upfront in cash. So XPV serves as a specialized financing arm.
I see. So Apollo and Blackstone provide the private credit to lease the equipment to the end users.
Right. And then Broadcom gets to record the massive hardware sales. The cloud providers get their chips without draining their balance sheets, and the private equity firms collect the yield on the debt.
On paper, that sounds like a brilliant way to accelerate sales, but the phrase buried in this Bank of America estimate that has Wall Street completely spooked is residual value guarantee risk.
Yeah, that is the ticking time bomb phrase.
I want to visualize this for you listening. This isn't like leasing a fleet of delivery trucks that will, predictably depreciate over 10 years.
Not at all.
Leasing AI hardware feels more like trying to lease out a fleet of early 2000s supercomputers right before cloud computing was invented. If the technology shifts, the hardware doesn't just lose some value, it becomes fundamentally irrelevant overnight.
The obsolescence cycle is the entire crux of the bear case here. In corporate accounting, a residual value guarantee means the lender, in this case, the entities holding that projected $370 billion in debt, requires assurance that the underlying asset will hold a specific minimum value at the end of the lease term.
Okay, so if the lease is up in 3 years and a massive technological leap renders today's state-of-the-art AI clusters entirely obsolete, the resale value of those chips basically crashes to zero.
Exactly. And if that residual value crashes below the guaranteed threshold, guess who is suddenly on the hook to cover the spread?
Broadcom.
Precisely. If Broadcom is providing these guarantees to facilitate the XPV financing, they are harboring a massive, unquantified liability.
Wow. So that $18 billion in free cash flow looks phenomenal today. But if they're quietly absorbing the depreciation risk of hundreds of billions of dollars worth of rapidly aging AI hardware, that pristine balance sheet is hiding a massive risk.
Yeah, and that leads to the big question. Is Wall Street overreacting to a hypothetical analyst projection for 2029? Or is the presence of this off-balance sheet risk a genuine reason to reevaluate Broadcom's fundamental value today?
I mean, the market reaction seems like a textbook response to unquantifiable risk at a peak valuation.
It is. Institutional algorithms and risk managers can accurately price in a bad earnings quarter. What they cannot price is a $370 billion black box a potential liability.
Right, because when a stock is trading at 68 times earnings, fund managers do not wait around for the company to clarify its off-balance sheet guarantees. They just dump the stock to manage their exposure.
Exactly. That 6% drop was the market aggressively demanding a risk discount.
But the financing black box isn't the only issue demanding a discount right now, is it?
No, it's not.
Because if Broadcom is theoretically on the hook for obsolete tech in 3 years, the last thing they need is a supply chain bottleneck delaying their ability to get the newest, most valuable tech to market today.
Which brings us directly to the geopolitical risk currently hanging over their manufacturing pipeline.
Right, and for you listening, we're going to dive into some proposed U.S. regulations here.
And just to be incredibly clear up front, I am simply relaying the regulatory risks outlined in our research today without taking any political stance on U.S.-China trade policy. We are just looking at the facts of the proposal.
Absolutely. We always stay totally impartial on the politics. We just want to know how it affects the wealth-building context.
Right, so the supply chain for AI infrastructure is highly globalized and, frankly, deeply fragile. The specific threat outlined recently is a proposed U.S. regulation that would ban the use of Chinese-made optical transceivers.
Okay, so strictly from a business operations standpoint, leaving the international politics entirely aside, we need to look at the math of how a ban like this impacts Broadcom's bottom line. Why are these specific transceivers so critical?
Well, an optical transceiver is a component that converts electrical data signals from the servers into light signals that can travel through fiber optic cables. Without them, the massive networking switches Broadcom sells just cannot function. If you are building a data center that requires high-speed Ethernet to connect tens of thousands of GPUs, you need millions of these transceivers.
Millions of them.
Yeah, and sourcing a significant portion of them from Chinese manufacturers has historically been the most cost-effective and scalable solution for the tech sector.
So if this proposal becomes enacted regulation, it forces an immediate material disruption. Broadcom would have to radically reconfigure a critical supply chain node.
Right, they'd likely have to start sourcing components from more expensive domestic or allied manufacturers.
Which directly threatens that pristine 68% gross margin we talked about earlier.
It does. Any forced restructuring of a highly optimized supply chain introduces friction. It delays product delivery, it increases the cost of goods sold, and it compresses margins.
And for a company priced for perfection, a margin compression of even 2 or 3 percentage points is pretty disastrous for the stock price.
Disastrous. And this friction is causing a massive divergence in how the so-called smart money is positioning itself right now.
Let's talk about that sentiment, because you read the institutional filings right now, and it is incredibly mixed.
They're very mixed.
You have a major hedge fund, third point, who completely dissolved its stake in Broadcom. They liquidated their position and walked away entirely.
Right. But then on the flip side, you have Soros Fund Management, and they actually confidently increased their stake by 6.5%, bringing their holdings to over 165,000 shares.
So you have two heavyweight institutional players looking at the exact same data and making totally opposite bets.
Yeah, and that divergence really reflects two different time horizons and risk tolerances. A fund like Third Point is likely applying a strict risk-reward framework.
Meaning they see the high PE, they calculate the geopolitical supply chain vulnerability, they factor in the XPV financing rumors.
And they decide the upside is fully captured, they lock in their profits, and deploy capital elsewhere.
But the funds adding to their positions, they are betting on the inevitability of the AI infrastructure supercycle.
Right. Their thesis is that $18 billion in 6-month free cash flow provides enough of a fortress to weather any temporary supply chain friction or debt restructuring.
But if we really want to understand the internal confidence level regarding that fortress, we need to look past the hedge funds and examine what the people actually running the company are doing with their own money.
Oh, the insider trading data.
Yeah.
Yeah, over the recent filing period, it is pretty jarring.
We saw 52 open market sales by Broadcom insiders. They offloaded a total of 715,885 shares.
And in that exact same window, there was exactly one insider purchase for a total of 1,000 shares.
A 715-to-1 ratio of selling volume to buying volume. That is an incredibly loud signal.
It really is.
And this is where I struggle with the broader market narrative. If you look at the analyst consensus right now, the major banks are rating Broadcom a moderate to strong buy, with average price targets floating somewhere between $513 and $527.
Right, projecting massive upside.
Exactly. But if the analysts are screaming buy, while the executives who actually look at the internal pipelines and daily operation metrics are dumping 715,000 shares? I mean, shouldn't you be taking your cues from the people inside the building?
Well, evaluating insider selling always requires some nuance, but a ratio of that magnitude transcends routine diversification.
Yeah, because we know executives sell stock to pay for real estate or cover tax obligations or just diversify their personal portfolios.
Exactly. However, executives typically only buy stock on the open market for one singular reason. They believe the current valuation is significantly lower than the company's future value.
Right. And when you see near zero conviction on the buy side from insiders coupled with heavy liquidations, it strongly indicates that management views the 68 PE multiple as fully valued.
They are locking in generational wealth because they do not see a near-term catalyst that will push that multiple significantly higher.
It's a pretty stark contradiction to the optimistic targets published by those sell-side analysts.
It is. And that contradiction really brings us to the tipping point. We have the incredible cash flow, the XPV debt risks, the transceiver supply chain vulnerability, and insiders heavily heading for the exits.
So let's look at the technicals, exactly where the stock is positioned right now, and the looming catalyst that will decide whether this valuation holds or collapses.
The current technical setup is incredibly precarious. The stock closed at $392.99. It has recently broken below its 20-day moving average, which confirms that the short-term momentum has completely fractured following that 6% drop.
But it is still desperately clinging to its 50-day moving average, which currently sits at $390.33.
Right.
And if you zoom out to the broader context, even after the recent plunge, Broadcom is still up over 26% from its 52-week low of $281.
And that 50-day moving average is the critical battleground for institutional investors. It represents the intermediate trend.
So when a stock falls to its 50-day line, long-term algorithms and value-oriented funds typically step in to buy the dip, assuming the broader thesis is intact.
Exactly. But if Broadcom breaks below 390 and fails to reclaim it, it signals a systemic psychological shift. It means the institutional buyers are stepping aside and the market is fundamentally repricing the risk.
And the catalyst that will decide that battle is arriving momentarily. Broadcom's fiscal Q3 2026 earnings report is scheduled for September 2nd, 2026. The consensus estimates are looking for approximately $29.4 billion in revenue and an earnings per share landing between $3.16 and $3.24.
But hitting those revenue numbers is just the bare minimum requirement. This earnings call is not going to be decided by a slight beat or miss on the top line.
No, the institutional analysts dialing into that call are going to demand transparency on the off-balance sheet liabilities.
Exactly. Management will be forced to clarify exactly what exposure Broadcom holds regarding the XPV platform and those residual value guarantees.
Furthermore, they really have to navigate the broader macro narrative that is starting to terrify the semiconductor space, which is this idea of AI capex fatigue.
Oh, absolutely.
We have seen quarter after quarter of hyperscalers spending tens of billions of dollars on AI hardware. What happens if, on September 2nd, Broadcom's forward guidance hints that companies like Google or Meta are finally starting to optimize their existing server clusters rather than aggressively expanding them?
If the phrase capex fatigue is even validated by Broadcom's management, the floor completely drops out of the stock.
Because the entire premium valuation is predicated on infinite scaling.
Right. If the hyperscalers pause to digest the infrastructure they have already purchased, Broadcom transitions from a hypergrowth AI darling back to a mature, cyclical hardware company.
And if that transition happens, if the stock breaks the 50-day moving average and the earnings call fails to dispel the XPV debt concerns, are we looking at a scenario where this multiple violently compresses all the way back down to that 52-week low of 281?
Well, multiple compression in the semiconductor industry is famously brutal. If the growth narrative slows and the hidden liabilities are confirmed, the market will re-rate the stock immediately.
So a 68 PE could shrink to a 35 PE in a matter of weeks under those conditions.
Easily. And a drop toward that $281 level is a highly realistic downside scenario.
Wow. We have covered a massive amount of ground today. To synthesize the final verdict for you listening, Broadcom is operating as the foundational toll booth of the AI revolution. It boasts a staggering 32% growth, dominant 68% gross margins, and generates cash flow that places it in the upper echelon of global corporations.
But it is currently navigating a perilous minefield.
Yeah. It is defending a premium valuation that demands flawless execution,
Right.
while simultaneously battling unquantified debt financing risks within the XPV vehicle, looming supply chain disruptions, and a glaring lack of internal conviction from its own selling executives.
It really is the ultimate test of whether sheer financial momentum can outrun structural risk.
Now, as we wrap up today's analysis, I want to leave you with a final provocative thought to mull over regarding that XPV debt. We talked about how residual value guarantees work for leased hardware, but think about the actual physical lifespan of an AI chip.
Right, they don't last forever.
We all see the breakneck pace of AI software innovation, with language models getting exponentially more complex every few months. So if massive financing vehicles are heavily relying on the residual resale value of today's leased AI hardware to secure hundreds of billions of dollars in debt, what happens to the entire financial ecosystem if the sheer speed of AI innovation renders today's state-of-the-art silicon completely obsolete in just 18 to 24 months?
It forces you to really question if the debt fueling the AI boom is actually backed by durable assets.
Exactly. Who is ultimately left holding the bag when a multi-million-dollar server cluster becomes nothing more than a wildly expensive paperweight? The foundational math of the AI infrastructure build-out might be far more fragile than the headline revenue numbers suggest.
Definitely keep a very close eye on the September 2nd earnings call to see how Broadcom management addresses these shadows. So taking all this into account, our investment rating on the current valuation requires some serious caution given the downside risks we've explored, despite the incredible long-term AI thesis.
Very well said. Thank you for joining us on today's talk. If you found this helpful, please remember to subscribe, like, and comment underneath. And don't forget to check out the special 14-day trial link below for StockOracle to explore these catalysts for yourself. Keep questioning the fundamental numbers driving the market narrative, and we will catch you next time.